So Matt, we're seeing a lot of news at the moment coming from America. Outspoken presidents are back again for a second term. We've had COVID in recent years, and going back a little bit further, the global financial crisis. Is what we're seeing now any different to what we've seen before?
So in short, no, in terms of how markets work. So obviously there's an awful lot going on in the world at the moment. Trump, Ukraine, Russia, nobody knows how it's going to unfold. But if we kind of step back and think about the global financial crash, for example, if we zoom in on that, it was a really scary time. It felt like there was an awful lot of unknowns at that point in time. If we think about COVID, if we zoom into 2020, there was probably even more unknowns. Nobody knew how the world was going to unfold. It's right, they should be asking questions about it, but markets are just behaving how they would normally behave. And yeah, they've fallen, but not too much. So in short, the reasons for the market falls are different, but should we be worried or doing anything different? Certainly not. How have you found you've been speaking to clients about it the last couple of months?
It's a good question. I think there's a hell of a lot to think about and digest, and you can tie yourselves in knots. And I think that if you explain to clients that in the short term there's a bit of reaction to news in the markets, and arguably a bit of an overreaction, and it's driven by sentiment and emotion rather than cold hard facts. And what we've seen historically, time and time again, over the different crashes we've talked about, is that the norm resumes if you give it enough time. How long you have to wait can vary, but unless we think capitalism has failed and isn't going to come back, then sit tight and ride out if you can.
Yeah, that makes sense. And if there's one thing that Trump's going to make sure it continues, it's probably capitalism long term.
So we talked there about big events in the world that cause a lot of uncertainty and market wobbles, but just more generally, that's the nature of investing, isn't it? That there's a degree of markets going up and down. What would you say to clients on that type of stuff?
Yeah, I think I've been speaking to a few new and potential clients about it recently, and particularly if people haven't had an advisor or haven't invested money before, it can be a big scary thing because it's different and people are used to having money in the bank, and it's relatively simple and they're not used to ups and downs. But if you're investing money, you just need to get to a point where you're comfortable with it, and it's a big part of our job to help clients get to that point and just normalise the ups and downs of markets. It's not a bad thing, it's only a bad thing if the markets fall and you need to take the money out at that point in time. But the discussions we have with new clients are that, right, okay, so you're going to need a few £100,000 in a couple of years' time. Don't invest that money. They should only be investing money that is for the long term, so the short-term wobbles really don't matter. But a big part of it is getting clients comfortable with it at the start, and the specific time of when they invest in the market. If we take a long-term view, it really doesn't matter. If we fast forward 20, 30 years to when clients are retiring and we look back and say, right, did you invest in February, March, April, May 2025? In the long term, it's very unlikely to make